everyone. This is the last video of our discussion series of the concept of income. So in this video, we will discuss the accounting periods as applicable in computing the income of a taxpayer. So the taxable income of the taxpayer shall be computed based on the taxpayer's annual accounting period in accordance with the method of accounting regularly employed in keeping the books of such taxpayer. So again, in computing the taxable income for taxation purposes, we need to compute the income based on an annual, no? The annualized income. That should not be more than or less than 12 months. So the term taxable year means the calendar year or the fiscal year ending during such calendar year upon the basis of which the net income is computed. So basically, when we say taxable year, this can be the calendar year which begins on January 1 and ends on December 31 of any year, whereas the fiscal year begins on any date of any month except January 1 and ends after 12 months. So when you say taxable year, this means one complete year, 12 months. So the income of any taxpayer may be computed using either of the following periods. Calendar year begins with January 1 and ends on December 31 of any given year. This period, however, is the only option that an individual taxpayer may have. So when we say individual taxpayer, this means that the person or any natural person can only use the calendar year when computing his taxable income. Okay? So any natural person with life, of course, cannot use fiscal year. Again, only calendar year is available to him when computing the taxable income. Whereas fiscal year, it is any 12-month period beginning any day during the calendar year other than January 1 and ending on the last day of any month other than December 31. So, the individual taxpayer is not allowed to use this period. Therefore, the fiscal year can be available only to partnerships and corporations. Okay? So the partnerships and corporation may use calendar year or fiscal year, but in the case of individual taxpayer, they can only use calendar year. Okay? When computing the taxable income. There is, however, an exception to the rule. Okay? The commissioner may prescribe an accounting method if there was no method of accounting that has been employed by the taxpayer, or if the method employed does not clearly reflect the income. Okay? So in some cases, the calendar year shall be used in computing the income if the taxpayer's annual accounting period is other than a fiscal year. Of course, if it's not a fiscal year, then it must be a calendar year. Or if the taxpayer has no annual accounting period, if he does not know what accounting period is, then the calendar year should be used. Or if the taxpayer does not keep his books, again, the calendar year must be used. Or if the taxpayer is an individual taxpayer, a natural person, because again, an individual taxpayer can only use a calendar year and not a fiscal year. Okay, so these are the cases where the calendar year shall be used. In reality, we apply calendar year. Normally, we apply calendar year, and I don't have any client using fiscal year. So anyway, in the case of death of the taxpayer, the decedent's taxpayer's income shall be accrued and computed from the beginning of the calendar year up to the time of his death, unless such income pertains and was already reported in the prior period. So for example, if the taxpayer died on November 1, 2020, so the income shall be computed from January 1 to November 1. Okay? We will not wait for December 31 to end the calendar year because there was no taxpayer from November 1 to December 31 because he died already on November 1. Okay, so the income shall be accrued only until such time of his death. For example, on June 1, 2018, Jean, a resident of Bayugan, decided to put up her retailing business. Registering on June 30, her bookkeeper suggested that she should use the fiscal year beginning July 1, 2018 and ending June 30, 2019 and years thereafter. Okay, so Jean decided to put up business on June 1 and registered her business on June 30. Her bookkeeper suggested to use the fiscal year beginning July 1 and ending June 30. For income taxation purposes, is the opinion of the bookkeeper correct? What do you think? The answer is no. Jean, as an individual taxpayer, can only use the calendar year period. Okay? For accounting purposes, Jean can use fiscal year, but for taxation purposes, she should use the calendar year only. Okay? Because Jean is an individual taxpayer. So now let's discuss the change of accounting period. Can the taxpayer decide to change its accounting period? The answer is yes, provided that the taxpayer is not an individual taxpayer. Because again, the individual taxpayers can only use calendar year. When I say individual taxpayers, these are natural persons like you. Okay? Thus, change of accounting period is not possible. Therefore, non-individual taxpayers or corporate taxpayers can choose to change their year. It can be calendar year or fiscal year, or from fiscal year to another fiscal year. If a taxpayer, other than an individual taxpayer, changes its accounting period from fiscal year to a calendar year, or from calendar year to a fiscal year, or from one fiscal year to another fiscal year, the net income shall, with approval of the commissioner, be computed on the basis of such new accounting period. So we'll discuss these three scenarios in the later discussion. Okay? So first, the final or adjustment returns for a period of less than 12 months. Uh, this is called adjustment returns because uh, it does not complete the 12-month duration. So after the approval of the CIR, a final or adjustment return should be filed with the BAR for less than 12 months if the taxpayer chose to change its accounting period. So for example, if the taxpayer, a non-individual taxpayer, is currently using a calendar year, then suddenly it decided to change to use a fiscal year. Okay? Then it should file first a notification to the CAR, to the BAR. And then after the approval, it must file or submit an adjustment return covering the short period, which is less than a month, less than 12 months, and these should be filed depending on when the adjustment took place. Okay? So this return is similar to that normal regular returns, like the income tax return, but it only covers the sales or receipts and incomes from the last time a return was filed up to the date of the change of the accounting period. So we will illustrate this scenario. For example, there is a change from calendar year to a fiscal year. So again, when I say calendar year, this begins on January 1 and ends on December 31. Now the change is to adopt a new fiscal year which begins any date of any month other than January 1. Okay? For example, ABC Company is currently using a calendar year in computing its taxable income. So ABC company is not an individual taxpayer, therefore, it is allowed to change its accounting period. On May 16, 2018, which is on the middle of the year, it decided to change its taxable period from calendar year to fiscal year, beginning June 1, 2018 and ending 12 months thereafter. How should this change be treated? So, again, ABC Company is currently using calendar year from January 1. And supposedly, this calendar period will end on December 31. Okay, however, on May 16, during the year, it decided to change from calendar year to fiscal year, which should begin on June 1, 2018 and will end on May 31, 2019, right? So how do we account this change? So assume this timeline. This January 1, 2018, the current year's beginning date, and then this is December 31, 2018, the should be end date of the calendar year. So this is one complete calendar year for ABC company. And then this is the old calendar year, okay? However, it decided to change to a fiscal year which begins on June 1, 2018 and will end on May 31, 2019 and years thereafter. The decision, okay, so this is the new fiscal year, okay? The decision was made on May 16, 2018. So how do we account? Okay? So if ABC company will have to shift from the calendar year to fiscal year, therefore there is an income that is yet to be reported that cannot be part of the new fiscal year, right? The new fiscal year begins on June 1, 2018. Therefore, it cannot include incomes derived from January 1 to May 31, 2018, right? Okay? So, this is the period the decision of change, no? So, in this period from January 1, 2018 to June 1, 2018, this is what we call the adjustment period. Why is it called the adjustment period? Because in this period, there will be incomes and expenses which cannot be included in our income starting June 1 to May 31, 2019. Because June 1, 2018 to May 31, 2019 is a new fiscal year, a new 12-month period. So, it cannot include our incomes on January 1, 2018. Therefore, ABC Company has to file a separate adjustment return covering the incomes and expenses from January 1, 2018 to May 31, 2018. Okay? So, when the new fiscal year take over, okay, so starting June 1, 2018, it will be a new year complete, no? The computation of our income will be from June 1, 2018 to May 31, 2019. That is 1 year complete, 12-month complete period. However, the short adjustment return, which begins on January 1, 2018 and ending on May 31, 2018, shall be separately filed to the Bureau of Internal Revenue. Okay? So again, from June 1, 2018 to May 31, 2019, this now becomes a normal return. So the important area here is the January 1 to May 31, 2018. Okay, so this is the change from calendar year to fiscal year. Always remember, it is easy to memorize because the start, you just need to count from the starting of the old calendar year, the start of the old calendar year to the start of the new fiscal year. So the start of the old calendar year was January 1, and the start of the new fiscal year was June 1. So therefore, we will end on May 31. That's it. So let's have another example. This is a change from fiscal year to a calendar year. So effective February 3, 2018, Bohr's company decided to shift from fiscal year of accounting to calendar year. Currently, its fiscal year begins on August 1 and ends on July 31. How should this change be treated? So, let's have again a timeline. So, this is the old fiscal year beginning August 1, 2017 and ending July 31, 2018. This is the old fiscal year of Bohr's company. Bohr's company decided to change from fiscal year to a calendar year. When we say calendar year, this begins on January 1, 2018, or in this case, I decided to put December 31, 2017. Anyway, that's the same. So ending December 31, 2018. Okay? So from August 1, 2017 to July 31, 2018, then that is one fiscal year. That's the old fiscal year. Whereas from December 31, 2017 to December 31, 2018, that is the new calendar year. Okay? The decision was made on February 3, 2018. This was the decision to change. So take note that the decision to change happened during the calendar year of 2018. Okay? It is in between of January 1, 2018 to December 31, 2018. So regardless of when the decision was made, our concern here is on the beginning of the fiscal year, the old fiscal year, and the beginning of the new calendar year. Okay? So in our case, we have August 1, 2017 to December 31, 2017. This is the beginning and the beginning, right? The beginning of the old fiscal year and the beginning of the new calendar year, like what we did in our previous illustration. So, in this case, there will be incomes from August 1, 2017 to December 31, 2017 that cannot be reported in the new calendar year. Why? Because it is beyond already with a 12-month period. So therefore, the taxpayer has to file a separate adjustment return beginning January 1, 2017 and ending December 31, 2017, so that from January 1, 2018 to December 31, 2018, it will have a new normal return. Okay? Again, do not confuse yourself on when the decision was made. Okay? Focus on the beginning of the old fiscal year and the beginning of the new calendar year, like what we did last illustration. In that case, from August 1 to December 31, 2017, that will be the short period that the taxpayer should file his return. So, you might be asking, why would a taxpayer file an adjustment return from August 1, 2017 to December 31, 2017? The reason is that beginning January 1 to December 31, 2018, the taxpayer has to account all incomes for 12 months. Therefore, those incomes beyond the 12-month period, meaning to say from August 1 to December 31, cannot be reported in the new normal return. Okay? Therefore, there must be a separate adjustment return. Okay? So, third example illustration is a change from fiscal year to another fiscal year. This is somewhat complicated, right? Or it sounds complicated, but actually it's very easy. For example, in June 2019, CatCat Company decided to change its fiscal year to another fiscal year. Currently, the old fiscal year begins May 1 and ends on May 30. It decided to begin a new fiscal year starting July 1, 2018 and 12 months thereafter. How should this change be treated? Okay, so fiscal year to another fiscal year. So let's illustrate the timeline. This is a timeline. Again, the old fiscal year begins on May 1, 2018 and ends on April 30, 2019. This is the old fiscal year. And the company decided to change from the old fiscal year to another fiscal year, which begins on July 1, 2018 and ends on June 30, 2019, and years thereafter. So this is the new fiscal year. The decision was made on June 20, 2018. Again, the decision to change is not material or can be ignored. Okay, so since there is a change from fiscal year to another fiscal year, it means to say that the incomes from May 1, 2018 to July 1, 2018 can no longer be part of the income or the return to be filed on July 1, 2018 to June 30, 2019, right? So therefore, there must be a separate adjustment return covering May 1 to June 30, 2018. Always remember the beginning of the old fiscal year and the beginning of the new fiscal year. So it's actually the same with the last two illustrations we have in the preceding um, minutes. Okay? So effective July 1, 2018 to June 30, 2019, the incomes will be covered under the normal return or normal income tax return. So again, the adjustment return will only cover the short period covering May 1 to June 30, 2018. Now, what if the taxpayer died during the year? So, we assume that the taxpayer here is an individual person because he died, right? So, an individual taxpayer, again, can only use, yes, a calendar year. So, for example, Alexis is a practicing lawyer who died on August 29, 2018 due to heart attack. A separate final return must be filed covering the incomes beginning January 1, 2018 until August 29, 2018. So, let's look at the timeline. Since the taxpayer is an individual, so therefore, the income shall be computed only using the calendar year, January 1, 2018 to December 31, 2018. However, Alexis died on August 29, 2018. Therefore, the incomes accrued or earned from January 1 to August 29, 2018 shall be covered under a separate return. Okay? So this is a separate final return. It's a final return because it's death of the taxpayer covering January 1 to August 29. How about starting August 30 to December 31? Of course, there will be no return because the taxpayer is already dead at that time, right? So there will be no more incomes. If the estate remained unsettled, for example, if the properties or the estate of Alexis, of the taxpayer, remained unsettled and continues to earn income, then the estate itself will be considered as a separate taxpayer. There will be no more Alexis from August 30 to December 31. Okay, so if there is incomes or if the estate continued to earn income, then the estate itself shall be considered a separate taxpayer. Now, how about cessation from business? When we say cessation, meaning the stop or stopping from doing business. For example, company liquidated its assets and liabilities with the intention to cease from business operation. On September 3, 2018, it completely stops operating. The company normally accounts its income using fiscal year, beginning March 1 and February 28 or 29. So now let's look at the timeline. So the taxpayer is using fiscal year, beginning March 1, 2018 and ending February 28, 2019. Okay? So it is qualified used for using fiscal year because it is non-individual taxpayer. So it decided to stop doing business on September 3, 2018. So we will not wait for February 28 to come because there will be no more business at that time. So the taxpayer shall compute its income from March 1, 2018, the beginning of the fiscal year, to the time when the business ceased from doing business. So that's September 3, 2018. So a separate a final return shall be computed on March 1, beginning March 1 to September 3, 2018. Okay? How about September 4 to February 28, 2019? Since there will be no more business, therefore there will be no more income tax return or income to be computed after the cessation of business. Okay? So I hope you learn a lot from this lesson and I hope you'll watch the next videos in this channel. Thank you for watching.